The economy is growing faster than expected, inflation is cooling, and Wall Street is partying. It all sounds good, except the Fed is getting worried about the job market. Why? Because although the data says the economy is strong, the job market is slowing. Now we're at the point where companies are hiring seasonal workers at the lowest rate that we have seen since 2009 during the Great Recession. And this is where the Federal Reserve Bank is facing a dilemma. How aggressive should they be to stimulate the economy to fix the job market without reigniting inflation? So let's break it down. In the beginning part of 2025, companies slowed down hiring because of tariffs and uncertainty with tariffs. Now here we are in 2025 and all the confusion around tariffs have gone down drastically, but the hiring problem did not get solved. We just have a new hiring problem. Actually, make that 3 problems. Number 1, we're seeing companies freeze hiring again, not because of tariffs, but because of artificial intelligence. The idea being, instead of hiring a new person or a new department to fulfill a task, how about we just build an AI agent or an AI bot that will be cheaper, that doesn't need a vacation, and that doesn't get tired? And if you don't believe me, just take a look at what the largest employer in the world, Walmart, is doing. Walmart just issued a 3-year hiring freeze because according to the CEO, AI is going to change every job and it's going to change how many employees they actually need. Number 2, as more companies get worried about the economy, they're being more cautious with how aggressively they're hiring employees, which is one of the reasons why we're seeing the highest number of layoffs in 2025 that we have seen since 2020 during the pandemic. Now, that being said, AI is anticipated to create more jobs than it replaces, but that shift is going to take time. And finally, number 3, this is the time of year where companies boost up their seasonal hiring for the holiday shopping spree, but companies are just not doing it this year. Read this. Seasonal employers are facing a confluence of factors this year. Tariffs loom, inflationary pressures linger, and many companies continue to rely on automation and permanent staff instead of large waves of seasonal hires. And these reasons are where now the Fed is trying to help stimulate the job market and stimulate the economy, which does obviously impact investors, which is where let's talk about what the Federal Reserve Bank is doing, what this means for the economy and investments. And I do want to remind you, for those of you that are investors or want to become investors, my team and I have put together a brand new investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. There's a ton of value in this masterclass. I'll show you the exact framework that my firm and I use to research investment opportunities and find opportunities before they hit the headlines. And when you register for this masterclass, you're also going to get access to Market Briefs, which is my newsletter for investors, all for free. So if you want to get the investing masterclass and Market Briefs all for free, all you have to do is click the link down in the description below to register. The Federal Reserve Bank is the central bank here in the United States, and their job is to help control the economy. That is, when it gets overheated, their job is to cool the economy down. When the economy is slowing down, their job is to help get it going again. And the way that they get the economy going again is by 2 things. Number 1 is they can change interest rates, and number 2 is they can create more money. Now, talking about interest rates, what we saw happen in 2025 is that the Federal Reserve Bank has begun cutting interest rates again. The goal with cutting interest rates is to make borrowing money cheaper. And the reason why that matters is because our entire economic system runs on spending. The more money you spend, the more money somebody else makes. And so if Walmart can borrow money cheaper, and they have more money to spend to open more stores, well, then they can hire more people. And so the idea with cutting interest rates is they want to encourage businesses to borrow more money, they want to encourage people to borrow more money, and they want to encourage the United States government to borrow more money, because all of these things spend more money, which can create more jobs, which can create more investment. But there is a consequence to that. And the consequence is, well, we can make asset prices higher. We can make bubbles bigger, and we could also trigger the inflation problem. This is where the Federal Reserve Bank has to play this balancing act, because they have a dual mandate responsibility. What that means is their job is to do 2 things. Number 1 is to manage inflation, and number 2 is to keep unemployment low. At the time of me recording this video, we know that inflation is right around 3%, while unemployment in the United States is at around 4.3%. Now, historically, if we look at the United States over the last 50 or 100 years, neither of these 2 numbers are of concern. 4.3% unemployment is actually really good historically. 2.9% inflation is actually considered very tame historically. The problem is where we've been and where we're going. Because number one, on the employment side, we have a lot of people that are underemployed, which means you went to college, you got a good degree, but you're working at Chipotle. So you have people that are working part-time jobs, people that are underemployed that make this number look better because a lot of people just don't feel that they can get a good job right now, especially with all the changes that are happening in the job market. Then when it comes to inflation, even if inflation is at a decent rate today, don't forget that we've seen a lot of inflation in 2020, 2021, 2022, 2023, and all that compounding of inflation builds on top of one another. So this inflation that we're seeing today is on top of all the previous inflation that we've had. And what we saw over the last 5 years is that inflation outpaced the average person's incomes. So yeah, you got a raise over the last 5 years, but chances are your income didn't keep up with the growth of your rent, of your groceries, of your car, of your vacations, and of everything else. And this is where the Federal Reserve Bank has to pick which side of this teeter-totter they want to put more focus on. Because if they want to boost this job market, then what they want to do is cut interest rates. But if you cut interest rates, that can make the inflation problem worse. Because if you spur spending and you create more debt, well, the value of the dollar could go down. You could see a lot of growth in prices of things, which could make the inflation problem worse. But if the Federal Reserve Bank keeps interest rates high, or they raise interest rates even more, well, that can then cool the inflation problem down, but then that can hurt the job market because when you make borrowing more expensive, well, now doing business can be more expensive because most businesses operate on debt. A lot of people spend on debt. I'm not saying that's a good thing, but that's just what happens in our economic system. And so if most of our economy is running on debt spending and you make that debt more expensive, spending goes down, which means people are spending less money at your company. And if your company is generating less dollars, then they have less money to pay employees. And that's when you start to see layoffs and a shrinking of the economy. And right now what we're seeing is that the Federal Reserve Bank is starting to say, this is becoming a bigger problem. Why is it becoming a bigger problem? Number one, because of AI. Number two, because of concerns about the economy. Then number three, because of what we're seeing in the seasonal hiring as well. But the reason why this is such a unique problem today in 2025 is because the data keeps saying that the economy is growing very quickly, but at the same time it says that the job market is not keeping up. Read this headline, I think it explains it very well. Economists expect faster growth, but weaker job gains through 2025. This is a unique problem. Companies are growing, businesses are growing, the economy is growing, but the job market is falling. And this is where the Fed is hoping that if they cut interest rates, they can stimulate the economy more to encourage businesses to hire more people. Take a read. Headwinds facing workers are the primary reason why the central bank, meaning the Fed, lowered its benchmark interest rate by 0.25 percentage points. Now, this is where one of the things I want you to pay attention to is what's going on here with AI, because AI is changing the job market and is changing our economy very quickly. We are seeing a ton of dollars flow into AI investments. We're seeing a ton of AI startups get started. We're seeing crazy high valuations with AI, and we're seeing a lot of companies that are, number one, reducing hiring because they want to replace employees with AI, and number two, they're also laying off employees by using AI to supplement that work. Meaning companies are finding ways to use technology to lower their costs and hopefully stay efficient. Now, AI is not capable to do a lot of things just yet, but it is getting smarter every single day, and there are concerns about AI building a bubble. But the thing that I want you to understand here is that even if AI is in a bubble, it does not mean that AI is going to go away. We're seeing crazy high valuations. Yes, if we see a bubble, we could see a stock market crash, we could see AI companies go bankrupt, we could see a lot of companies get hurt during that time, but that doesn't mean that AI is going to go away. And this is why it is so important for you to be an investor and understand what's happening in the economy, because the reality is if you work a job or even if you have a business, you have to understand how to use AI. Because the number one threat is not you being replaced by AI, it is you being replaced by somebody who understands AI. And I'm telling you this from experience. I run a company called Briefs Media. We are transitioning it to Briefs Finance. And when I realized how fast AI is growing, I thought that we were going to be out of business in 10 years, in 2035. Then I started doing some more digging, and I realized, oh crap, we are on pace to be out of business, bankrupt by 2030, because we're a media company, and AI can create content way faster than humans can. Sure, maybe it's not as good as humans yet, but it's getting smarter every single day. And that's where we made a pivot. We had to figure out how we can stay competitive in a market that is driven by AI and this new technologies. That's why we're transitioning to Briefs Finance. We're building an amazing, we're spending so much money, time, and energy building new tools, softwares, AI for investors. We're launching it in 2026. And I'm saying this not to sell the product. I'm saying this to tell you that AI is changing our economy very quickly. And the people that understand this are going to be the ones that still can grow and accelerate the wealth even faster, and the people that don't understand this are going to fall behind even faster. And this is whether you run a business or work a job, it is changing the entire economy. And I'm telling you this because it's happening right now. I'm seeing it happen, and I'm telling you from my own experience how important it is for you to start to understand these tools and how it is going to change the economy. So that being said, we are seeing a shift in our economy. We are seeing a shift in the job market. The economy still is holding out strong. The job market is slowing. We're going to be seeing changes with the Federal Reserve Bank trying to stimulate the economy. That could make the inflation problem worse. All of these things go back to why it is so important for you to be an investor, because the economy is shifting and you want to be ahead of these shifts, not behind these shifts. If you want some more resources on how to be an investor and research investment opportunities, again, I have an investing masterclass for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor to help spread the financial education. Thank you. Russia accused the United States of trying to devalue its $37 trillion of national debt without informing the American people. How? By using stablecoins, crypto, and gold. So if you hold dollars or stablecoins or have a retirement fund, you want to pay attention. Why does Russia care that the United States government has $37 trillion worth of national debt?